We're counting down the top 10 U.S. cities where the housing market is collapsing fastest in 2025. From pandemic-era boomtowns now facing double-digit price drops to unexpected metros unraveling from oversupply and risky loans, these rankings reveal where home values are plunging by as much as 24%. Which city faces the steepest crash? Let's begin with number 10. Number 10 is Denver, Colorado, where home values have dropped 11% from their 2022 peak, according to the Zillow Home Value Index. The most striking weakness shows up in far northeast neighborhoods like Green Valley Ranch, where a surge of new construction has left the market with more homes than buyers. Permitting data reveals that this area alone accounted for over a fifth of Denver's single-family permits in the past year, far outpacing demand. Homes in Green Valley Ranch now sit on the market for 30 to 45 days, triple the pace seen just 2 years ago. For buyers who use 2-1 buy-down mortgages, the risk is even sharper. Between 12 and 19% of these recent loans are now underwater, exposing both homeowners and lenders to losses if prices keep sliding. Denver's moderate decline hides deep structural risks in its outer suburbs, setting the tone for even steeper drops in other cities ahead. Sarasota, Florida, sits at number 9, with home values down 12% from their 2022 peak. The drop isn't spread evenly across the metro. Along the coast, places like Siesta Key remain popular with retirees, keeping prices near their highs and sale-to-list ratios above 98%. Inland, it's a different story. In North Port, a wave of speculative building has left the market with the highest months of supply in the county, pushing prices down and listings to linger. Demographic trends matter here. Steady retiree inflows are cushioning some neighborhoods, while the outskirts absorb most of the pain. The city's overall decline is steeper than Denver's, driven by excess inventory in its outer reaches, even as its coastal core holds firm. Washington, D.C. lands at number 8, with home values down 13% from their 2022 peak. The city's real estate story is shaped by federal hiring cycles and a stubborn glut of new condos, especially in the Northeast. Months of supply for condos in that area have jumped 35%, leaving many listings to linger. Yet, the market's divide is sharp. On Capitol Hill, homes sell in under 20 days, fueled by steady demand from government workers and professionals. In contrast, Anacostia faces days on market over 60, reflecting slower turnover and weaker buyer interest. The capital's diversified economy has softened the blow, but persistent inventory overhang keeps recovery uneven. Fort Myers, Florida, ranks 7th with a 13% drop in home values since 2022. But the story here isn't just about storms or insurance. In the sprawling outskirts, especially Lehigh Acres, rapid-fire construction by investor-backed builders has flooded the market with new homes. Inventory piled up so quickly that the average property now sits unsold for more than 70 days, twice as long as in 2022. Foreclosure filings in Lehigh Acres have jumped 45% year over year, according to Lee County MLS data, reflecting a sharp uptick in distress among recent buyers and small landlords. Unlike the insurance-driven pain in nearby Cape Coral, Fort Myers' struggle is rooted in builder saturation and speculative overreach. The glut in these peripheral tracts is a warning sign for other fast-growing metros. When supply outpaces real demand, even a booming region can tip into a steep correction. Birmingham, Alabama, stands at number 6 with a 15% drop in home values since the 2022 peak. The decline is anything but even across the city. In Ensley, vacancy rates have climbed above 20%, leaving block after block of empty houses and boarded-up storefronts. East Lake, another historic neighborhood, faces a different challenge. Foreclosure filings there have surged by more than 60% over the past 3 years, as job losses and stagnant wages pushed more owners into distress. These patterns are concentrated, not citywide. Just a few miles away in Vestavia Hills, Top-rated schools and stable demand have kept prices resilient and turnover low. Birmingham's correction cuts deeper than in many Sun Belt metros, driven not by overbuilding, but by persistent economic stagnation and sharp divides between neighborhoods. For buyers, the city offers steep discounts, but only in areas where recovery is far from certain. San Francisco's housing market has fallen 16% from its 2022 peak, but the decline hides a sharp split between segments. In the city's east, neighborhoods like Soma and Mission Bay are weighed down by a glut of new condos. MLS data shows condo month supply at 8.2, more than double the city's single-family average. Many listings linger, with days on market in these towers stretching past 40. Meanwhile, classic single-family neighborhoods on the west side tell a different story. In No Valley, for example, homes still draw steady demand, averaging just 18 days before sale. The result is a market where new-build condos struggle to find buyers, while established family districts remain resilient. For buyers, this divergence means opportunities in high-rise inventory, but far less room to negotiate in West Side single-family homes. San Francisco's uneven drop sets the stage for even steeper declines elsewhere in the Bay Area. New Orleans ranks fourth, with home values down 19% from their 2022 peak, according to the Zillow Home Value Index. The impact reaches beyond homeowners. As property values fell, the city's property tax intake dropped by 9% year over year, straining already tight municipal budgets. City Council finance dockets from early 2025 detail how reduced revenues forced difficult choices, including deferring maintenance on drainage systems and slowing new affordable housing projects. In neighborhoods like the lower 9th Ward, homes now linger on the market for an average of 75 days, among the longest in the city. Tourism and hospitality jobs have yet to fully rebound, leaving many residents with fewer options. The city's housing decline is no longer just a private concern. It's reshaping public services and deepening the fiscal pressure on New Orleans' recovery. Cape Coral, Florida, stands out for the scale and speed of its reversal. Home values have dropped 20% from their 2022 peak, the steepest fall among Florida's largest cities. The roots of this collapse stretch back to a building frenzy that began in 2021. Lee County's permit approvals quadrupled in just 2 years, flooding the market with new homes. By 2025, as much as 35% of the homes completed in late 2023 were still unsold or being rented out at a loss. Builders like D.R. Horton and Lenner, who once raced to meet demand, now hold entire blocks of empty spec homes. But supply isn't the only pressure. Insurance premiums have soared in the wake of Hurricane Ian, with average wind coverage quotes in Cape Coral now topping $15,000 a year, and many owners facing bills as high as $20,000. For buyers, monthly costs have doubled since 2021, leaving many unable to qualify for loans or forcing them to walk away. The double blow of oversupply and insurance shock has made Cape Coral the epicenter of Florida's housing correction. Austin, Texas, stands shoulder to shoulder with Oakland for the sharpest home value drop in the country, down 24% from its 2022 peak, according to the Zillow Home Value Index. The city's rapid rise as a pandemic-era magnet has given way to a notable reversal. Data from Realtor.com show Austin's median listing prices falling 4.8% year over year as of September 2025, while Redfin reports a similar 4.47% annual decline. The double confirmation, both a steep drop from the peak and ongoing yearly weakness, sets Austin apart from most other Sun Belt metros. Neighborhoods like Runberg, once popular with investors and first-time buyers, now see homes lingering on the market for an average of 80 days, the highest in the city. Tech layoffs and the end of remote work booms have thinned the buyer pool, leaving sellers to slash prices or withdraw listings. Despite Austin's strong long-term fundamentals, the city's correction is broad, deep, and persistent, offering rare leverage for buyers but little relief for owners who bought at the top. Oakland, California, claims the top spot with a staggering 24% drop in home values since the 2022 peak, equal to Austin in scale, but with sharper neighborhood pain and deeper personal consequences. The city's retrenchment is anything but uniform. In Rockridge and Montclair, limited inventory and top schools have kept prices surprisingly resilient, with homes still attracting multiple offers. But just a few miles away, the story turns grim. In Temescal, a mid-tier homeowner who bought at the market's height in spring 2022 listed their house in late 2024, only to find offers coming in 8% below their mortgage balance. Weeks of anxious price cuts brought no relief. The listing expired after 90 days on the market, and a letter from their lender confirmed the new reality: negative equity, with no easy way out. Across East Oakland, similar scenes play out. Days on market now stretch past 90, as buyers vanish and investors circle distressed properties. Agents describe a market where hope has given way to resignation, especially for those who stretched to buy during the pandemic surge. Oakland's headline decline conceals a harsh divide. Some neighborhoods still hold strong, but for many families, the collapse feels personal and irreversible. This is the starkest example of how a citywide average can hide the pain concentrated in just a few blocks, crowning Oakland as the epicenter of America's housing market reversal. From Denver's moderate 11% slide to the dramatic 24% drops, seen in both Oakland and Austin, this countdown reveals just how severe the housing correction has become in certain U.S. cities. The most shocking entries, Oakland's sharp neighborhood divides and Cape Coral's unsold home glut, highlight that no single factor drives these collapses. Across all 10 cities, recurring themes emerge: oversupply in newly built suburbs, surging insurance costs in Florida, tech sector volatility in the Bay Area, and the reversal of pandemic migration trends in places like Austin. Each city earned its spot based on peak-to-now declines in Zillow's Home Value Index, focusing on mid-tier single-family homes. These numbers aren't just statistics, they point to deep shifts in affordability, local economies, and even city budgets. While the national market has leveled off, the extremes on this list show that downturns can be highly local and often sharper than headlines suggest. The 2025 map of U.S. housing risk isn't uniform. It's a patchwork shaped by supply, demand, and local shocks. For buyers and policymakers alike, these trends are a warning. The next housing story will be written city by city,